UK taxes have become increasingly hostile to investors. Whether you're building a share portfolio, investing in property, or simply looking to make the most of your savings, the government has created an environment where tax-efficient growth is harder than ever. Dividend tax is one of the biggest culprits. The dividend allowance has been slashed to just £500 per year, meaning that any dividend income above this is taxed at punitive rates of up to 39.35% for additional rate taxpayers. Capital gains tax is now payable on even the most modest profits, with the annual exemption reduced to a mere £3,000. And meanwhile, property investors have seen the tax treatment of mortgage interest severely restricted. You can no longer deduct all of your finance costs from your rental income, which results in a higher tax bill even if your profits haven't increased. At the same time, the available shelters from tax, pensions and ISAs have their own limits. You can only invest up to £20,000 per year into an ISA, and while pensions are incredibly tax efficient, the annual allowance is capped at £60,000 and often less for high earners, with restrictions on access until age 55 or later. So in short, if you're a higher rate taxpayer and have already used your tax wrappers, you're quickly left with very few options. But there is an alternative that more investors are waking up to, using a limited company to invest. Hi, my name's Carl and I'm a chartered financial planner. In these videos, I'm not giving you advice. These are just ideas for you to think about and then go off and do your own research on. Many people are surprised at how straightforward it is to set up a limited company in the UK. You can register one online with Companies House in less than an hour, often for under £15. Once the company is formed, you simply open a business bank account and deposit funds, either by lending the company money or by subscribing to shares, and then you're ready to start investing. Now, in the early stages, there's no legal requirement to use an accountant immediately. Annual accounts and a corporation tax return will eventually be due, but most investors keep things simple in year one and seek professional help only when needed. And this makes it very accessible for those just starting out. Now, unlike ISAs or pensions, which limit your investment choices, a limited company can invest in almost anything. So that includes traditional assets like UK and global equities, ETFs, exchange traded funds, but also buy-to-let property, physical gold, and even cryptocurrencies such as Bitcoin. As long as the activity is legal and properly declared, your company can become a flexible investment vehicle tailored to your personal financial strategy. This broad remit allows the company to act as a multi-asset investment platform that you fully control, without needing to ask permission or work within narrow parameters. When a limited company invests, the tax environment is very different from personal investing. Profits on investments, whether capital gains from selling shares or net income from rental properties, are subject to corporation tax, not personal tax rates. Now, at present, corporation tax sits at around 25% for companies with profits above 250,000, but can be lower for small companies with modest profits. Rental income is treated as trading income, and all legitimate expenses, including full mortgage interest, remain deductible. This alone makes a company ownership significantly more attractive for property investors compared to individual ownership. Importantly, you retain control over when and how profits are withdrawn. Tax is only incurred when money leaves the company and enters your personal hands, giving you the power to defer and plan your income. So let's have a look at some of the long-term advantages of control and flexibility. Perhaps the most compelling reason to invest via a company is the range of options it gives you. You don't have to take your income immediately, so you can let profits compound without triggering personal tax. And if you started the company with a loan from your personal funds, money you later withdraw can be classed as a repayment of that loan, not income, and therefore tax-free. You can also add other people, such as a spouse, partner, or children, as shareholders over time. And this can be done with different share classes if needed, allowing you to split income and control how wealth is passed on. It's an incredibly useful structure for long-term family succession planning, and far more flexible than relying solely on pensions or trusts. Moreover, you can run multiple companies alongside each other. So if you already operate a limited company through your main business or consulting work, you may be able to use excess profits from that company to fund your investment company. A formally documented loan from one company to another, handled correctly, can be a fast, tax-efficient way to deploy retained earnings into a growth-orientated portfolio. The company structure is particularly beneficial for buy-to-let property. Since the mortgage interest relief restriction doesn't apply to limited companies, you can fully offset interest payments and reduce taxable profits. You also benefit from corporation tax treatment on gains where properties are sold, avoiding the 28% personal capital gains tax rate that applies to residential property. Reinvestment is also simpler. Profits can be retained in the company and used as deposits for future purchases without triggering personal tax liabilities. Over time, this can help build a property portfolio faster than in a personal ownership. Lenders now routinely offer limited company buy-to-let mortgages. While interest rates and fees may be slightly higher, the ability to deduct all mortgage costs and reinvest profits tax efficiently can more than make up for it. One overlooked advantage of investing in property via a limited company is how it can help you continually refinance interest-only mortgages, even as you get older. Now, when you hold property in your personal name, lenders will often impose age restrictions on mortgage terms. Many won't lend beyond age 70 or 75. And this can make it difficult to refinance or extend interest-only deals later in life. And this becomes a real constraint if you're relying on property as a long-term investment or income source. However, with a limited company, the focus shifts away from your personal age. The company is a separate legal entity with no age limit, and the directors and shareholders can change over time. By bringing younger family members, such as your adult children, into the company as shareholders or directors, you can position the business to continue borrowing well into the future. Lenders underwriting the mortgage will typically look at the company as a whole, including the income from properties and the profile of its directors. As long as at least one director or guarantor meets the lending's criteria, refinancing can often proceed even if the original founder is retired or no longer involved day to day. This approach not only keeps financing options open, it also creates a natural route for succession planning, gradually involving the next generation in the family investment business, while keeping control and flexibility. So who should consider a limited company? Now, this approach won't be right for everyone, but it is particularly compelling for higher rate taxpayers, successful business owners, and investors who have already used up their ISA and pension allowances. It's especially suitable if you have surplus income or profits that you don't immediately need. You're building a long-term investment portfolio, whether in shares, property, or alternatives, and you want control or more control over how and when tax is paid. And you're thinking about succession and how to pass on wealth efficiently. The limited company route can be an ideal bridge between traditional wrappers like ISAs and pensions and more advanced strategies like family investment companies or trusts. In an era of shrinking tax allowances, frozen thresholds, and even more complex rules, using a limited company to invest is becoming a natural next step for many sophisticated investors. It allows you to take back control over your tax planning, diversify your investment options, and build a flexible structure that works for you, not the taxman. For those willing to put in a little extra admin and think longer term, the rewards can be significant. A limited company may just be the smartest way to grow and protect your wealth in today's environment. I hope you found this video useful today. If you have found some value in it, please give it a like. And if you're new to the channel and you haven't already, please hit that subscribe button because there's plenty more videos like this coming soon. Until next time, take care.